Hey everybody, it's Joshua Phillips with Churchill Mortgage, and I thought I'd start with that dramatic image. Mortgage rates spike higher. Boy, it has not been a good month for mortgage rates. There's just no way to, coat that over. It has just been bad. Well, hey, I'm Joshua Phillips with Churchill Mortgage. I work with the Phillips team here. My wife, Amy, my son, Jesse. If you're working with the Phillips team at Churchill Mortgage, you're in great hands. Well, it's March 27th. And guys, it has been rough. It has been a rough month as mortgage rates have continued to kind of inch and sometimes jump higher as we've continued to be in this Iran conflict. You're seeing it in the stock market. You're seeing it pretty much in every market, whether it's precious metals, crypto, stocks, or mortgage rates. Everything's pretty darn bad. Well, let's get to a couple of the headlines. So, I mean, as we're saying here, this was on CNBC a couple of days ago, and boy, we are feeling it. Mortgage demand drops more than 10%. Rates hit their highest level since October. Now, here's the thing. This news is a little bit behind. I mean, we're higher than we were in this article here, just because news travels a little bit slow and reports on mortgage rates travel a bit slow. So, this is suggesting a mortgage rate of 6.43. To be honest, we're a little higher than that right now in most cases. Although, yes, you can, buy your rate down potentially, but expect rates to be at least a half, maybe moving toward 0.75% higher than where we were at the start of the month. Well, let's go here to our mortgage-backed security chart. This is what we always look at. And I always like to say that every professional loan officer in America has this screen, and I'm sharing this screen with you. This is what we look at as loan officers, mortgage-backed securities. That's where mortgages are bundled and sold as securities, and that is the most direct relationship to mortgage rates. Now, here's all you really need to know. As I always say, green is good, red is bad, and the higher the security price, the better mortgage rates are doing. So it's inverse here. Well, so this is a 90-day chart. Let's pull out here. Let's pull it to more like a 1-year chart to get a little more perspective. So we saw rates last year. They kind of were pretty bad in the spring, but we kind of been on this nice long run through the end of the year where mortgage rates were getting a little bit better and better and better, and then we kind of just crested, and mortgage rates were good, and then boy, March 1st hit, and you can see we lost all this ground in just less than a month. So, that's kind of the picture of what we're looking at like with mortgage rates, with mortgage-backed securities. So let's come back in here. All right, for anybody that's a math nerd, which I certainly am, let me make a practical relationship here to how things are. So when we're here sitting at 101.66, and then we drop to 99.63, that means we've lost about 200 basis points, okay? So let's say a 6% interest rate cost 1% discount point. Well, today it's probably going to cost 3%, 3 points. We're adding that 200 basis points, that 200, 2% to what the cost of a rate is. As I often said, if you watch these videos, rates don't change. It's just the cost of a rate that changes. So again, maybe let's say, I'm not trying to quote this specifically, but let's say, for example, that a 6% interest rate cost a 1% discount point, and we've lost 200 basis points. So now that same rate costs 3% of the loan amount. So it's gotten a lot more expensive. And, as a consumer, I will tell you, I often point consumers to the 10-year Treasury yield. Mortgage rates do fairly closely reflect this. So if we pull this up, 4.43 today. Clearly, we can see the spike. This is a 1-year chart right there. We had actually hit 3.96. Whoa, back on March the 2nd. Was that March the 2nd? Oh, no, 227, 3.96, and we have jumped higher. Again, you can see again in the visual that we're kind of like back to where we were last summer. So, again, there's so many ways we can look at this. It's just bad. And there's no way to predict the future unless you can tell me where oil prices will be in 2 weeks, 4 weeks, 6 weeks. Who knows? I mean, we are in, uncharted territory, or certainly something we haven't seen in a long time. And you just don't know how these conflicts are going to resolve and if they're going to resolve quickly. But hey, here's the thing. If you're looking to refinance, you probably are going to be holding off. Some people have to refinance. Maybe you need cash out, or we can always do a home equity line of credit. If you're looking to purchase a home, if you're in the market to purchase a home and you need to purchase a home, certainly the rates are the rates and you just need to go ahead and purchase. Now, do I think that a rate hike rates going up 0.5%, maybe 0.75%, is that a reason in my mind to just I'm just not going to buy this year? Probably not, because you don't know what rates are going to be in a year from now or 2 years from now. So, just to say I'm going to wait, you have no guarantees. There's absolutely no guarantees that a year from now, 2 years from now, that rates will be any better. They might be worse. So, we have seen a substantial amount of improvement, even at today's rates versus 2 years ago rates, where we're seeing rates in the sixes versus in the sevens and even eights back 2, 3, 4 years ago. So, it kind of is what it is. I hate that saying, but it is what it is. And we just have to go with, whatever the market's giving us. Let's all pray that this conflict gets resolved quickly. And maybe we'll see the market start to calm down. Things start to come back. I think if this can get resolved or we pull out of Iran, probably over several weeks, we'll see mortgage rates hopefully start to come back. Perhaps to where we were. But again, we don't know. All right, well, listen, feel free to reach out to Amy, Jesse, or myself if you'd like to talk about your loan needs, your loan situation. We'll advise you as best we can while we don't know the future. So, all right, take care. We'll be in touch. Bye-bye.